Hey guys, and welcome to this week's Finance in 5, where we take you through the 5 best things we found in the world of finance and property. You got Jayden and Josh here for this week. Josh, what do we got first up?
Yeah, we've got a really interesting one here, Jayden. There's been some changes around the first home loan deposit scheme, and I don't know. I'm still on the fence. I mean, is it good? Is it bad? What do you think, Jay?
Let's go through the details. It's as a part of the budget, the government's come out and said, hooray! We ran out of spots, but we've got another 10,000 first home loan deposit scheme spots. So this is the one where the government basically acts as a guarantor for your loan, and you can borrow with as little as 5% deposit. Sounds pretty awesome, right? I guess take us through the detail on what the extended scheme involves, Josh.
Yeah, so essentially it's only for newly constructed properties. So this also includes, interestingly, off the plan properties. So I was actually surprised that they're including that. But if you're looking at house and land packages, if you're looking to build, things like that, well, then you're eligible.
Yeah, the other good thing is they've increased the price caps. So in Sydney, I think it's $950, Victoria, sort of $850, Queensland, $650. Like, for example, in Queensland, you can only use the first home loan deposit scheme on purchase or build up to $475. So, that's all positive, and obviously more positive because there's another 10,000 spots available. I think the thing that sucks with this, Josh, I've got a couple of problems with it, right? The first is that it's only available if you're building and you can't buy on an existing property. So you're kind of trapped into either building a brand new place or buying something off the plan, which sometimes those places are a bit inflated. So you're going to be paying a bit of a premium. The other thing as well is it doesn't help if you're buying a block of land. So you need to potentially have a builder and everything lined up right now, which sucks with home builder, right?
It does, and probably one of the things you're going to be be careful of is that you need everything lined up. So we've had a few examples recently, Jayden.
Dude, I had one this week where to settle the first home loan deposit scheme, you need to have your land contract signed and you need to have your building contract signed. But then the problem with the home builder grant is once you've signed your build contract, you've got to start construction. They have to turn the dirt within 3 months. And the builder's like, dude, there's no way. It's going to be 6 months minimum. So you just got to be careful of that, because on one hand, you're going to get the first home loan deposit scheme, awesome, but it might disqualify you for the 25,000 home builder grant. So I don't know, it's a bit of it's a tough one.
And if you're looking to access the old scheme where you didn't necessarily have to buy new, unfortunately, all spots are taken. So bit of a bummer there. If you've missed out, this is probably the only scheme now. You have to buy brand new.
And the other thing that sucks too, you got to remember, we were lucky last year because the first home loan deposit scheme is based on financial year. So they launched it in January this year, which was really exciting. And then it reset the 1st of July. But this year, it's not going to reset until July 2021. So that's a long time between now and then.
Now, on our second topic, the housing outlook for 2023. Not all bad, is it, Jayden?
Pretty positive. Like, even the budget rhetoric around that, if you've been following that, all the economists have been saying, like, stuff's actually not too bad considering. Obviously, government spending and stimulus has helped, but the property prices, the forecast is looking pretty good there. Like, you can see Brisbane 0.9 up, Sydney and Melbourne, obviously, like, it's been tough. It's been a really hard lockdown down there. If you're down there, sorry, but.
And yeah, look, there's some big winners and big losers for the forecast. As we can see here, Perth, it's forecasted to grow. If you're looking at buying a house, 7.5%, units, 6.8%.
Yeah, I think the thing more interesting, if you keep going down there, Josh, is what's driving the household market. So first home buyer activity is up 13% in the year to June for 2020, which we've been noticing that too. Like the amount of people, and even I'm sure you guys have too, where I guess you're not going on holidays. You can't, if you're in Melbourne, you're locked down. It was pretty hard to spend your money on just dumb stuff unless you're on Amazon doing that.
And we've noticed a big change in, a lot of people, they've got 40, 50 grand that they were looking to go to Europe, right? And now unable to do that.
Man, I reckon 2 in 5 inquiries are people that are like, oh, I had this money earmarked to go to Europe, maybe get married, to spend it that way, and like, we're going to bring our house buying plans forward. And that's just made all this extra activity, which has made more competition, which ultimately is leading to those property price increases.
And what we're also finding is that more people have more time on their hands. They're working from home. They don't necessarily have to be at the office for 8 hours. So we're seeing that, 8 hours worth of work is getting done in 6 hours. People have 2 or 3 hours each day surfing the web.
Yeah, you're just on realestate.com.au, you're on Domain, like, I don't know. I do that.
Yeah, so the market is going crazy at the moment.
Yeah, pretty wild. Next point.
Yeah, so the next point we've got here is changes and rollbacks to some tax deductions.
Yeah, so this was as a result of the budget. I'm sure everyone's been following it super closely. The good news, there's a good page by ABC with the budget winners lose. We'll include it in the link below. But the good news was just for ordinary people like us, taxpayers, where they announced a bunch of really good tax cuts. Josh walks through.
Yeah, so it essentially means that if you're earning between $45,000 and $90,000, that you can end up with another about $1,000 in your back pocket. So really awesome news there.
Yeah, I think the so what of this for the property market and for you guys, if you're looking at buying your home in the next little while, is the extra net income after tax means more borrowing power, more serviceability. So Josh, give us a couple of 4 examples.
Yeah, so let's take a quick example here. We've got a borrowing capacity calculator, and essentially all that is short for how much can you borrow. So now looking at the borrowing capacity here, we've got someone earning $60,000 with a credit card. With that additional $1,000 in tax-free income, let's have a look at how much that increases their capacity. So we're looking at Bank West, that's increased by $25,000.
It was 15,000, buddy. It was from 430 to 445. All good. Math.
That happens. So it just goes to show $1,000 might not sound a lot, but that's a lot of money that you'll be able to borrow for virtually for free.
Yeah, and you've got to remember there's 2 parts when you're buying a house. There's your borrowing capacity, it's how much you're earning, and there's your deposit, which is your risk and that sort of stuff. So you need both to buy a house. But if you've got good deposit and you're just getting home back by your income, these changes are going to make a huge difference.
Now, on our 4th point, there are some rollbacks to some self-employed applicants. Jayden, what's going on?
Yeah, so with COVID, the banks tighten up a lot of stuff. It was one of those things that it happened overnight, 6 weeks later, and while COVID hit and the lockdowns happened, we found sort of about 5-6 weeks later, Westpac and all their associated banks, I'm talking St. George, Bank SA, Bank of Melbourne, basically reduced, just got super conservative with COVID. So they stopped waiving lenders' mortgage insurance for doctors, which sucked. So where they previously allowed doctors to waive lenders' mortgage insurance with a 10% deposit, they were saying, no way, we need 15%. And also they were waiving lenders' mortgage insurance for accountants and lawyers. They said no dice. They actually completely scrapped that. So they've rolled that back. But the biggest change, Josh, self-employed.
Yeah, so Jayden, what we saw during COVID is that they reduced that to 80%. They didn't want to help self-employed people.
So in other words, you needed a 20% deposit if you're in self-employed and you're applying with Westpac, right?
That's exactly right. Now they've changed that. Now you can have mortgage insurance. So if you're self-employed, you're looking to get back in the market, we have noticed that banks are really starting to become more lenient. They're wanting to lend again. And I mean, we saw this in the Royal Commission, didn't we, Jayden? Last year, when the Royal Commission was happening, it was a knee-jerk reaction, and essentially lending almost became near impossible.
Yeah, and it sucks because if you're a customer of Westpac forever and you tried to apply, and just because you owned a cafe or you're self-employed, they would say no. They actually would just decline your loan, shows up in your credit file, it's no good. So again, talk to a broker. Happy to help if you're in that situation, just to make sure you can kind of navigate this stuff, because it's not getting easier.
And the final topic we've got here is responsible lending changes. So we're starting to see a bit of a change in the market. Again, lenders are starting to become more lenient and more around the assessment rate.
Yeah, so again, these responsible lending changes aren't going to officially get rolled out until March next year. So it hasn't passed law, but the government sort of said, hey banks, chill, we need you guys to thaw out rather. We need you to keep lending, put money out in the market and help the economy recover. But we've actually started to see some of those rollouts happen, because ultimately the responsible lending stuff in the Royal Commission, it meant that the banks were lending you less money even though you're earning more, and asking you way more questions on Uber Eats. They were wanting to know credit cards. They were having to close out HEX lines. It was crazy, the amount of muck around it's doing. But yeah, the one that we've noticed this week is that assessment rate.
That's exactly right. Now, the assessment rate essentially determines how much the bank can lend to you. So having a quick look at an example here, we can see the top one here, ING, their assessment's 8%. Whereas, we see, say, Suncorp, which is a little bit lower, it is allowing you to borrow more money. So really good news.
That's the wild thing. So for example, if you apply for a home loan with ING today, and you could get a fixed rate of 2.29%, or it's cheaper even, ING will look at your loan and they say, Joshua is going to apply for a loan of $300,000, And although he's going to pay 2.29% today, we're going to calculate the repayments based off 8%. That's outrageous. That's crazy. Like, interest rates aren't going to be 8% for a very long time. So that's where, we're starting to notice some of this rollback. I think Westpac was one of the banks that reacted this week. I think they dropped it by about 0.4%. It hasn't updated on that calculator yet, but it just means pretty much more borrowing capacity, really, which I covered in the video last week I did on responsible lending.
And there you have it. There are the 5 tips, the finance in 5 for this week. What do you think? We'd love to hear from you. Comments below. And remember, hit that subscribe button now.